In this video, we're going to be performing a deep dive on McDonald's dividend safety. To begin, let's talk about McDonald's business model. McDonald's is the largest publicly traded restaurant company in the world. The Oak Brook, Illinois-based company was founded in 1940 and has a market capitalization of $140 billion. McDonald's has over 37,000 locations in more than 100 countries. Over 90% of the company's restaurants are owned and operated by independent local businessmen and women. McDonald's is a well-known dividend stock because of its compelling track record of dividend growth. With 43 years of consecutive dividend increases, McDonald's is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of dividend increases. Looking ahead, investors cannot rely on McDonald's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss McDonald's dividend safety in the context of the company's current earnings. When McDonald's reported fourth quarter financial results on January 30th, the company announced that it generated adjusted earnings per share of $1.97 in the 3-month reporting period. For context, the company currently pays a quarterly dividend of $1.16 per share, which implies a payout ratio of 59% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. McDonald's generated diluted earnings per share of $7.54 in fiscal 2018, and its current annualized dividend payment is $4.64, for a full-year payout ratio of 62%. Using earnings, McDonald's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare McDonald's current dividend payment to its free cash flow. In fiscal 2018, McDonald's generated $7 billion of cash flow from operating activities and spent $2.7 billion on capital expenditures for free cash flow of $4.3 billion. The company distributed $3.3 billion of common stock dividends during the same time period for a free cash flow dividend payout ratio of 77%. Using free cash flow, our conclusion is the same as when we use earnings to measure McDonald's dividend safety. The company's dividend appears safe for the foreseeable future, although we note that its payout ratio using free cash flow is noticeably higher than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze McDonald's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. McDonald's performance during this time period is shown here. Remarkably, McDonald's was actually able to increase its earnings per share each year through the financial crisis of 2007 to 2009. With that in mind, we don't have any concerns about the company's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess McDonald's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. At the end of fiscal 2018, McDonald's had $31.1 billion of debt outstanding. The company generated $981.2 million of interest expense in the full fiscal year for a weighted average interest rate of 3.2%. The following image shows how changes to McDonald's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, McDonald's weighted average interest rate would need to rise to above the 6% level before its dividend would no longer be covered by free cash flow. This is a much lower margin of safety than many of the other blue chip stocks that we have covered in this dividend safety analysis series. Still, we believe that McDonald's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on McDonald's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.